Welcome to the deep dive. Today, we're really getting into the weeds of the global markets. We're looking at what's actually driving things using this great weekly market brief from JP Morgan Asset Management. It's dated September 15th, 2025, so, hot off the press. Our goal here for you is simple. Cut through the noise, find the important stuff, connect those dots, and really help you grasp the bigger economic picture. Forget just the numbers. We want the surprising facts, the key insights. Okay. Let's unpack this.
Yeah, absolutely. And it's a really vital time to do it. This isn't like just some dry academic report. It's more like a snapshot, capturing these huge decisions by central banks, how markets are reacting like right now,
Yeah.
and understanding these signals, these trends. It's just crucial because, well, they affect everyone, right? Big institutions, sure, but also your own finances.
Totally. So let's jump right in with what JP Morgan calls their thought of the week. It's all about the European Central Bank, the ECB. Now, if you've been following, you know the ECB has been incredibly active. I mean, 8 straight interest rate cuts between June 2024 and June 2025. 8. That's quite a run of easing. But the big news, the pivot, came from their meeting last week. The Governing Council decided on, no change to interest rates. They hit the pause button back in July, and now they've held steady again. So, okay, after cutting so aggressively, what does this stop actually mean for the Eurozone? And, for you watching all this.
It's a really, really significant change in tone, I think. President Lagarde, she and her colleagues basically said they think policy is in a good place.
Mm-hmm.
That phrase, in a good place, it's key. It signals like a real confidence that they've maybe done enough stimulus for the moment. And here's where it gets kind of fascinating. The ECB's own projections show inflation actually undershooting their 2% target. We're talking 2026 and 2027. So you have to ask, right, if you expect inflation to be low, why stop cutting rates now?
Yeah, it feels a bit counterintuitive, doesn't it?
It really does. So what's the thinking? What's a balancing act here making them pause? The brief mentions a resilient labor market and better than expected activity data. How does that override the inflation forecast? Well, that seems to be the crux of it. Even though those inflation numbers are looking low down the road, they're seeing unexpected strength right now. The job market in Europe is holding up surprisingly well. Economic activity is stronger than they thought it would be. So they're probably a bit wary, wary of cutting more and maybe accidentally stoking inflation again later, especially after everything we've been through. It's like saying, okay, let's just wait a minute. Let's see if this growth is real before we push the pedal down further. And the implication the brief draws out is pretty major. Absent a sharper deterioration in growth or a substantial appreciation of the euro, it appears that Europe's cutting cycle may now be done. Oh, what's amazing is just how fast that story can flip, right? A few months back, it was all about how fast they'd cut now. Maybe no more cuts at all. It signals a whole new phase, potentially higher rates for longer in Europe. And for businesses, for investors, well, that changes things. Borrowing costs, growth expectations, you have to adjust.
Wow, yeah. That really is a potential turning point for Europe. Okay, so the ECB's made its move. But as you said, other big economies, they're still lining up for their own decisions, their own data. And this is where it gets really interesting, I think, because what happens this coming week, it could seriously set the tone for global policy for, the rest of the year. So what should you, our listener, really be keeping an eye on? What are the big ones?
Okay, there are several key events stacked up. First, the United States. The FOMC, that's the Fed's rate-setting committee, they had their decision on Wednesday. Their last rate was 4.50%, and seeing what they do after the ECB pause will be absolutely critical. We also get August data for the U.S. industrial production, which was 1.4% before, and retail sales prior was 3.9%. These give us a feel for the underlying health of the U.S. economy. Is it still chugging along?
Right, the U.S. picture is key. What about elsewhere?
Then, across the pond, the Bank of England, their rate decision is Thursday. Prior rate was 4.00%. That'll be watched closely. But maybe even more important for the UK is the August headline CPI, the inflation number, which lands on Wednesday. The previous figure was 3.8%. That's still pretty high, much higher than the Eurozone, for example. So that CPI print will really weigh heavily on what the bevy decides to do or not do. They're still wrestling with sticky inflation. Yeah, the UK situation does seem tougher. Further east, Friday is Japan Day. We get both the Bank of Japan's rate decision, their prior rate was only 0.50%, and the August core CPI, which was 3.1% last time. And it's worth remembering, Japan's in a totally different boat policy-wise compared to the U.S. and Europe. Much lower rates, a different inflation dynamic.
Okay, and any others?
And one more big one. Monday brings China's retail sales for August year-on-year. Prior was 3.7%. That gives us a window into consumer spending, consumer confidence, and a massive global player.
Okay, so it sounds like just a week absolutely packed with economic signals, potential fireworks, maybe. Like you said, these aren't just diary dates, they're real pulse checks for the entire world economy. Put them all together, and we should get some much clearer clues about where global policy and economic health are actually heading. All right, so with those big decisions hanging in the balance, let's pivot to the markets themselves. How are investors reacting now? What are the numbers telling us? Are there like surprising trends or divergences showing up? What's the story in the investment world?
Well, the story seems to be one of clear differentiation. Investors are definitely picking favorites right now. If you look at stocks, some regions are doing incredibly well. The IBX in Spain, for instance, up a huge 36.1% just this year and 40.1% over the past 12 months. And MSCI China, too strong performance, up 37.1% year to date and an amazing 62.3% compared to a year ago. These kinds of regional surges, they usually point to specific local factors, right? Maybe reforms clicking or unique growth stories or just sentiment recovering strongly in those particular markets.
Interesting. And what about sectors? Are we seeing winners and losers there too?
Oh, definitely. Big time. Look at technology, up 3.4% just last week and a really solid 16.8% year to date. And communication services even better, up 27.4% year to date and 44.2% year ago. That screams investor confidence and growth, right? Betting on innovation, future earnings. But then you look at the other side, more defensive plays. Healthcare was actually down 0.3% last week, and it's only up 1.6% for the whole year so far. Consumer staples, too, down 0.6% last week, up a more modest 6.5% year to date. So yeah, it tells a clear story. Right now, investors seem to be favoring that growth potential over stability.
That growth versus defensive split is really stark. Okay, but here's where, for me, it gets kind of confusing, maybe contradictory. When we look at bonds and commodities, so on the bond side, you see spreads across global investment grade, emerging markets, global high yield. They're all showing negative changes. They're tightening, weak, year to date, year ago. Can you just quickly explain what tightening means in practice? And what does that usually signal about risk?
Sure. So tightening just means that the extra interest, the extra yield, investors demand for holding riskier bonds compared to safer government bonds. Well, that extra bit is shrinking. It generally suggests investors perceive less risk. They're becoming more comfortable lending money to companies or emerging market governments. It usually points towards improving economic sentiment, maybe lower borrowing costs ahead.
Okay, less perceived risk. And yet, look at the U.S. 10-year Treasury yield. It's sitting at 4.06%. But the really striking thing is it's down quite a bit this year, like net 51 basis points year to date. So if we're still talking about inflation potentially being sticky, what does a falling long-term yield like that suggest? Are markets betting on slower growth? Or maybe that inflation will fall faster than the Fed thinks?
That's a great question. It often implies.
And hang on, then there's gold. Gold is at $3,644 an ounce. That's extraordinary. Up 38.8% year to date, 42.9% compared to a year ago. What is going on with gold? What's driving that massive rally?
Yeah, gold's performance is really something.
But then contrast that with oil. Brent crude is around $66 a barrel. And it's down this year, negative 11.2% year to date, and down negative 8.8% from a year ago. So, gold, the classic inflation hedge or safe haven, is soaring while oil prices are falling. How do we square that? It feels like a puzzle.
It is a puzzle. And that's often where the most interesting market insights lie, isn't it? In those contradictions. Okay, so gold surging while oil falls and long-term yields dip. One interpretation, a common one, is that investors are leaning into a sort of disinflationary growth narrative. They might be buying gold partly as a hedge against, geopolitical risks. It always likes that. But maybe also betting that while inflation does cool down, maybe economic growth doesn't completely collapse. So gold works as a haven if there are shocks to that growth, or even if central banks have to ease again later if things slow too much. The falling oil price kind of fits the disinflationary part of that story, suggesting softer global demand, perhaps. So yeah, it's this complex interplay between risk, inflation views, and growth outlooks. It's not simple.
Okay, disinflationary growth. That makes some sense of the pieces.
And if we look at some other key numbers, some macro stuff, here's a real eye-popper from the brief. China's CPI inflation. It's at negative 0.4%.
Negative. So prices are actually falling.
Exactly. Deflation.
Yeah.
Which points to, significant weakness in demand over there. It's like the whole economy is on sale, but nobody's buying enough. It's a totally different challenge for Beijing compared to the inflation fight elsewhere. They're battling under demand.
Wow. Okay, and meanwhile, back in the UK.
Right. The UK CPI, as we mentioned, still high at 3.8%. Compare that to the Eurozone at 2.1%, the U.S. at 2.9%. It just underscores the persistent inflation challenge the Bank of England is facing. Their job looks trickier right now than the ECB's, arguably.
And the U.S.?
U.S. GDP growth, still looking pretty solid at 3.3%, shows remarkable resilience in the face of those higher rates. The economy keeps surprising on the upside.
Okay, and lastly, valuations.
Yeah. Valuations tell a story, too. The S&P 500 in the U.S. trades on a forward price-to-earnings ratio of 22.6. That's quite a bit higher than MSCI Europe at 14.8 or the UK's FTSE 100 at 12.8. So a higher PE like that usually means investors expect more, right? They're willing to pay a premium for future U.S. earnings growth. It might suggest higher confidence in U.S. companies, or maybe it just reflects that growth sector dominance we talked about earlier, which is heavily weighted in the U.S. market.
Got it. Lots of moving parts.
So, okay, let's try and tie this all together. What's the big picture message from all these threads?
I think it's that the global economy is definitely not moving in sync. You've got the ECB hitting pause,
Wow.
critical meetings coming up in the US, UK, Japan, and then these really diverse market signals, gold booming while oil slumps, tech flying high while staples lag, China actually seeing deflation. It paints this really complex, almost fragmented picture. Pockets of strength, yes, but also very distinct regional challenges and uncertainties. Different economies, different playbooks. That's a great way to put it, different playbooks. So for you, the listener, trying to make sense of all this, what are the really crucial takeaways from this deep dive? How can digging into this brief help you, filter the daily news or even just think about your own situation?
I think the main thing is don't expect simple, uniform answers right now. Embrace the complexity, look for these divergences, ask why. Why is Europe pausing when the UK still has high inflation? Why is gold doing that when oil is doing this? Understanding the why behind the numbers, that's where the real insight is. It helps you see the unique pressures and opportunities in each major economy and how they all sort of interact. It forces you to see the global economy not as one single thing, but as this dynamic, interconnected, well, organism maybe, with lots of different parts doing different things.
Fantastic synthesis. Okay, so just to recap our journey today, we saw the European Central Bank hit a significant pause, maybe ending its cutting cycle. Big deal. We flagged those absolutely critical central bank meetings coming this week, Fed, BOE, BOJ, that could really stir the pot. And we explored some fascinating market action, gold's wild ride versus oil's dip, China's surprising deflation, and that clear split between growth and defensive stocks.
And all of this, I think, leaves us with a really interesting question to chew on after this deep dive. Given this really varied global picture, Europe pausing cuts, the UK still fighting inflation, the US looking resilient but facing choices, China dealing with deflation, markets sending mixed signals, how might these very different paths being taken by different countries and regions, how might that reshape globalization itself? Or international investment flows? Are we going to see surprising new connections emerge? Or maybe deeper divisions, more fragmentation as everyone follows their own distinct strategy. What do you think comes next from these diverging paths? It's something to really ponder.
That is a great question to end on. Definitely food for thought. Thank you for joining us on the deep dive. Stay curious, keep asking questions, and keep exploring this constantly changing global economy. We'll catch you on the next one.